Hi everybody, welcome again. In this tutorial, we'll talk about before tax cash flow calculation. So let's go. Here is the data. The company has working interest of 100%, which means that the company has 100% of sharing in OPEX and CAPEX and revenue. Then we have initial production rate of 200,000 barrels per year, and we have a decline rate of 20% effective yearly. And then we have royalty of 25% of revenue, and we have federal tax rate, which is equal to 20% of taxable income. And the oil price is about $30 per barrel, and operating cost variable is $5 per barrel, and fixed operating cost is equal to 20,000 barrels per year. And we have a capex of $5 million, and we have a depreciation scheme declining balance of 20%, and we have a discount rate of 10%. So let's start with calculation. First thing, we will calculate production forecast using exponential decline, using this decline rate of 20%. So second year forecast will be equal to 200, and we'll make it fixed, multiplied by 1 minus decline rate of 20%, and we'll make it fixed power to the year number, which is equal to 1, and we will copy that down. Then we have oil price of $30, so we'll make it fixed, and we'll just copy it down. Then we will calculate revenue, which is equal to production multiplied by oil price. So the first year revenue is equal to $6 million. Then we will calculate what's called royalty, which is equal to revenue multiplied by the percentage of royalty, which is equal to 25%. Then we will calculate operating variable cost, which is equal to operating variable per barrel, which is 5, multiplied by the total production, multiplied by our working interest, which is 100%, and we'll make it fixed, and we just copy down. Then we calculate the total operating cost, which is equal to the variable operating cost plus the fixed operating cost. Then we will calculate what's called operating income, which is equal to revenue minus royalty minus total OPEX. Then we will calculate what's called before tax cash flow, and with this will equal to the operating income minus the capex. Then we cum our before tax cash flow, and this year will be equal to the first one. Second year will be equal to the first one plus second one, and we copy down, and we show them in cash flow diagram. We have two curves here, the undiscounted cash flow, which we calculated now, before tax cash flow, and the after tax cash flow discounted, which we'll make through the course. Then we have some calculated indicator, which will be introduced in the course. And finally, we will go through a sensitivity analysis. So if you are interested to make the economic model, please join us in PEA platform for Petroleum economics course on 13 or May. So thank you, and see you there.